Changing gears here, we've got Alex Deluce, editor-in-chief and founder of the Gold Telegraph, in conversation with Mike Gentili of Bastion Asset Management, talking about the role of gold and critical minerals in an evolving world environment. Gentlemen?
All right, it's great. Firstly, I'd just like to start this off by thanking Joanne and her entire team here for putting on another very successful event here in Quebec City. So thank you very much to the staff. And I'm very excited to be having this conversation with Michael at a very pivotal moment in the global economy where things are just transforming very quickly. So we don't have much time, so we'll jump right into it. So, Michael, with central banks accumulating just rapid amounts of gold and geopolitical tensions escalating, are we witnessing the birth of a multipolar reserve system? And if that's the case, how could that fundamentally reshape global trade flows and alliances?
Yeah, my thesis consistently since 2018 has been a de-dollarization and a rotation out of the US dollar as a reserve currency into other. And I think gold wins by default because the other fiat currencies are just as upside down as the US dollar would be. So that's been my thesis. You've seen that consistently happening. I think in 2015, 95% of US treasuries were held by foreign buyers. Fast forward 10 years later, it's 75%. Gold used to be 5-6% of FX reserve central banks. Today it's between 15 and 20. So you see one reserve class rolling over, one rolling up. I think two things happened, Alex, in the last 5 years that kind of turbocharged my thesis, actually last 3 years, the Russia-Ukraine war in 2022, when the US froze the Russian currency reserves, US dollar reserves. That was a major shot in the air for any country who's had a disagreement with the US over the last, let's say, 50 years. Goes, well, am I really safe holding my reserve currencies in US dollars? Regardless of what you think of what Russia did or not, it definitely sent a shockwave through countries that have maybe had a more challenging relationship with the US over the years, saying I've got to get my reserves out of US dollars into gold. And then the second thing was the tariffs recently, which has caused a lot of the countries, you said geopolitically, to reconsider their trading relationship with the United States. Yeah. And just as you're trading more with countries outside the US, more in a survival instinct right now, you're going to be trading in other currencies and less likely to want to hold that other currency in your reserve account. So converting that to gold, you're seeing that with China, the Shanghai physical gold demand, the reserves. And so I think you've had a multi-decade trend of emerging the last 5-10 years, but those two events have probably turbocharged it and accelerated that trend. So yeah. Yes, we are going to see gold take more and more of a place on the central bank's reserve statement, and there's a long way to go, given how overowned the US dollar is, say, as a reserve asset class.
Yeah, well, it's brilliantly said, Michael. I recently had, well, a while back, I had Pierre Lassonde on my show, and one of his core theses is he really believes the Shanghai Gold Exchange is fighting for control of the gold pricing power over the West. And I think that's slowly unfolding right now. So shifting gears a bit, and it's still connected to that same theme, and global debt now is over 320 trillion, and central banks have been buying bonds for years, and it's propped up the system that's now looking quite fragile. And well, in last week we saw just rhetoric out of Germany that there's mumblings that they want to bring back their gold reserves from the United States. And with that being said, are we witnessing a growing loss of trust in a debt-based system? And if that's the case, what's your take on where debt markets stand today, and how might this shifting trust dynamic reshape the future of global finance?
Yeah, I think there's been a kind of aha moment or a wake-up moment in the markets where people look at $37 trillion of debt. You look at interest rates hovering at 4 or 5%. Round numbers, 40 trillion of debt, which will be there in maybe 12 months or so, times 5% on the 30-year bond. That's $2 trillion US per year in interest payments alone. The US revenue is about $6 trillion a year. So 33% of your annual spending will just be to service the interest on your debt, let alone pay it off at all. I mean, if you're an individual, 33% of your revenue is paying off your credit card interest, you'll be insolvent very, very quickly. So I think there's been kind of a shotgun moment where the market said, whoa, we're past the point of no matter what Doge does or no matter what Trump tries to grow out of it, we're just so much debt that we can't get out of that debt cycle.
Yeah.
We were talking earlier just offline about how followed the markets for 25 years, and when the NASDAQ, S&P crashed 15-20% about 2 months ago, I'd never seen in my career a market where the market is crashing, market's in free fall, bond yields are going up, and the US dollar is going down. That confluence, I had never seen that before. And I think what was happening was the bond market was realizing the problem is the bonds. The debt is the problem. And so that was a very spooky and kind of terrifying confluence of events. And so when the bonds usually trade up in a sell-off in the equities, people rotate to safety.
Yeah.
Investors were saying the bonds aren't safe anymore. I got to rotate to something else. What was actually rallying was gold.
Yeah.
That was a very telling moment, I think, in the market where you reach that point where investors are starting to realize that treasuries are no longer the safe haven they used to be, right? And so that gold will take a lot more and more of a place, and that typical relationships between equity markets and bond markets, US dollar, may no longer be holding in the long term.
Yeah. Well, it's unbelievable what's happening, and I'm sure, Michael, you've followed a lot, or you've been following with like the Bank of Japan, for example. I always say it, gold. Readers in the room that have read my work for years, I've always said gold is a hedge against stupidity. And the Bank of Japan, they've owned over 50% of their government debt, and and their bond yields now are going higher and higher. So it's unbelievable what's going on around the world in debt markets. And so with that, shifting gears, Michael, to the importance of discovery and mining, mineral exploration, and you touched on why gold is so important right now, but mineral exploration in terms of expenditures is at historic lows at the moment. How can the industry in itself try to propel that to make sure that we allocate more dollars to make the next wave of discoveries?
That's a great question. So if you look at since the last top in, let's say, 2012, exploration spending has been in a consistent downturn. And if you adjust it for today's inflation-adjusted dollars, it's even more dire in terms of the actual real dollars you're spending on exploration. So you're right, exploration has been completely hollowed out. The large companies spending very little in exploration. If you look at 2015, the lows of gold, $1,100 gold, some of the biggest companies in the world like Barrick and Rio Tinto were upside down. They were having balance sheet solvency issues. So when you're in that kind of situation, you're clearly cutting anything that's non-essential to survive. So the industry has been starved of capital for exploration. And what's really unique about this cycle, Alex, which is also I've never seen in my career, gold price making new all-time highs, and yet the capital available for the junior resource space, some of you are junior resource CEOs in the room, you know how tough it's been to raise capital and how scarce that capital has been. So we're starving the industry from a bottom-up funding basis. The majors have been underinvesting in exploration, and that's why you see very few new discoveries and very little potential for supply growth in the gold and copper industries, right? So that's a major issue. How do we solve it? I've invested in all sectors. I've been really focused on gold the last 8-10 years. I kind of take a venture capital approach to my portfolio and sort of say I'm going to put 1% of my money in every promising early stage resource investment that I can make, buy 25 to 30 names like a VC fund would buy, fully knowing that a lot of them are going to fail, but the ones that do go all the way to become a mine or a significant discovery will go up 20, 30, 100 times your money. So I think we need to rethink. The capital markets in Canada feel kind of broken to me. The funds, AUM of precious metals funds or commodity funds are way down. There's less interest. So how do we attract non-traditional capital? I've been pitching a lot of my friends in venture capital saying, hey guys, you don't understand that risk profile. You understand the distribution, that you're going to have one Facebook or one Google and the rest are not going to do really well, but those will make you tons of money. And by the way, the entry point of the valuation of these early stage resource companies are 20 to 30 times cheaper than an AI startup that you're investing in. So look at this distribution, theoretically should earn way higher returns. So that's private equity, pension plans, endowments, family offices. Can they rethink their allocation in that way? Can they systematically encourage good behavior? We could talk a lot of the bad behavior I see and why a lot of resource companies are uninvestable. Yeah. But when you have that dedicated capital, long-term capital, you have more influence on the boards and management teams, you could probably improve your outcomes as well. So that would be a hope to kind of broaden that audience and broaden the pools of capital. I think the markets will come back. New high gold prices, the companies we're starting to see some life in the junior market, but as a complement to that, sticky, long-term, sustainable capital in complement to the kind of more cyclical capital would be really helpful.
No, for sure. And Michael, you've had a career of just so much success. And with that, what are the criteria that you really look for when you're evaluating a new opportunity?
So I'd say two things. I mean, I've invested in producers. Like my first 15 years of my career was all investing in producing mines. So what I tried to do when I got in the wild west of junior exploration investing was really, how do you re-engineer the successful things that made mines and try to identify that as early on, even if it's a 5, 10 million market cap company, how do you identify these attributes that will tell you either this is going to be a mine or not going to be a mine? So taking that attribute, you have grade, you have scale, jurisdiction, you have management, you have permitting, and inside ownership, really, really important. Kind of from a high level, quickly, what I look for, and then obviously you got to get in the weeds in each of those points, and also understanding the cycle. Yeah. So I've learned, you're a big fan of Pierre Lassonde, I am as well. The Lassonde curve takes you through the different stages from discovery to resource expansion to building the mine to first production. I try to tweak that by saying, where are we in the sentiment cycle? Because the Lassonde curve will go up and down depending on where we are sentiment-wise. To give you an example, lithium 3 years ago was the hottest thing on the planet, and an early stage greenfield lithium story might have a $100 million market cap before they even make a discovery. Whereas gold has been in the doldrums for many years, that same risk profile, that same type of early stage might have a $5 million market cap. Well, if you're paying 5 or 100 million for the same risk-adjusted probability, I'd much rather own the 5, because if I'm right, I'm going to make multiples of my money. If I own the 100 million thing and it doesn't do well, I'm going to lose $100 million. Yeah. So I try to invest at points where there's pessimism, where I feel the cycle is going to go on an upturn. So not only do I get the Lassonde curve on my side if I'm right, but I also get a rising tide lifts all boats. And so what's very unusual about this gold cycle is we still have very high pessimism levels where the outlook for the commodity has never been better. And that is something I've never seen in my 25 years of doing this, which is why I'm so bullish on precious metals right now.
Well, and that sets up, Michael, like I know everyone in this room would love, with your experience in this space, like how does, with where we are in the cycle, how does this relate to other moments in your career in terms of the general sentiment and just the overall just health of the industry, given we are at record gold prices? So and a lot of these junior exploration companies with great deposits, they still aren't getting any love. So with regards to that, in that context, where do you think we are in your view when you relay it through your years?
Yeah, I mean, how I've made money in the market, when something's not working or you're not making money in investment, if you can answer the reason why, yeah, that usually give you the reason why it's going to resolve either positively or negatively. Sometimes you find out, well, it's not working because I've missed these 3 factors that would tell me this is why you're wrong and you're about to lose a lot of money, or actually, no, these are fundamental reasons why it's not working, and these how they're going to be resolved, and actually they're positive, and the market will figure it out eventually. So I think in the gold sector in particular, you're seeing, as you know, record margins. Gold price at $3,300, $3,400. We've never seen this level of kind of pure gross margin cash generation from these companies. And I think what's happened is the market doesn't believe that gold prices are sustainable. It reminds me a bit of, in the late 90s when oil was $10 a barrel. Everybody thought it was going to go to 5, and it went to 15 or 20 instead. A lot of the oil stocks, when oil started going from 10 to 12 to 14, getting very, very low multiples, because everybody assumed the oil price could go back down to 5 or 8. It's not sustainable. And when the oil price sustained itself, not only did it sustain itself, but it went higher. The energy stocks went on a huge multi-year run, huge multiple expansion, huge richness created for investors. I think we're at a stage where it's clear, if you read the financial statements, that the industry has never been more profitable. Balance sheets have never been in a better position. The corporates are in fantastic shape. Every quarter that goes by where they continue to print these record levels of cash flow, more and more generalist money will flow into the sector. And that will eventually trickle down to the smaller cap stocks that will benefit from that tailwind. So I believe, as we talked earlier, the gold price is sustainable. I believe the margins will be a lot stickier and stronger for longer. And the valuations today are levels that are reflective of maybe $2,400 or $2,200 gold price. So the longer we stay above 3,000 or higher, you're going to see a massive re-rating in the stocks. You're seeing how the stocks have traded the last couple of weeks, let's say months, where when the gold price is down, they're no longer trading off. They're kind of flat on the day. When the gold price is up, they're trading higher. That tells you more generalist money and more belief is coming that these gold prices are sustainable, and the sell-offs are buying opportunities, not chances to liquidate your portfolio and get out, but actually buy more. That's a very positive thing I'm seeing as well.
One, and looping back just a bit, Michael, on debt markets and potentially this next catalyst for gold, like with the discrepancy and the distress, and it's interesting. Another gentleman I had on my show recently was Sean Boyd at Anico, and he really described the present environment of just being we're in a state of disorder. And with that, when you see the debt markets behave like it recently did, and we were chatting offline about that, in terms of the next move by central banks, if bond yields continue to rise, do you foresee a situation where they might have to step in and do quantitative easing?
100%. I think there's no other, the numbers I gave you are irrefutable. If you have a 5% bond yield and 40 trillion of debt, it's $2 trillion of interest.
Yeah.
The US government cannot afford $2 trillion interest. The interest, by the way, this past year was $1 trillion. So you're doubling, and they're already running a $2 trillion deficit off that $1 trillion of interest. So they're going to have no choice but to cap bond yield at a certain point. So what do you want to call it? Yield curve control, QE. Actually, for the audience benefit, the U.S. government bought $43 billion of long bonds last week. They don't call it QE, they call it intervening in the market to provide stability. What that means, there was no bid, and they got to step in to keep bond yields. So they're already doing it. They're doing it quietly. They just haven't come out. And 43 billion, in 2008 would have been a big deal.
Yeah.
That's just sort of quietly, we just bought 43 billion, don't worry about that, sweep it under the carpet. So they're doing it already. You mentioned Japan, the 30-year bond yield at 3.5%. The carry trade's been a huge reason why U.S. yields have been suppressed. You borrow money in Japan at 0%, and you invest in U.S. treasuries at 3 to 4%. Well, if you can make 3 to 4% in Japan, that carry trade disappears. And so you're seeing people selling their U.S. bonds to buy Japanese bonds. The Japanese have to intervene in their bond market to buy Japanese bonds. How do they find the proceeds? By selling U.S. treasuries. Yeah. So this whole too much debt globally is going to start to really pile up. So yeah, I think we'll see yield curve control, quantitative easing, money printing, whatever you want to call it. All that is basically devaluing the dollar and printing more money to subsidize your debt, which the hard assets will do very well in that scenario.
Well, and it's remarkable to think that the two biggest holders of U.S. treasuries is Japan and China. And with what's going on geopolitically right now, it's and the weaponization of the dollar, like you alluded to at the beginning of our discussion, it really sets the framework for gold to thrive. And with that being said, with the weaponization of the dollar, do you foresee a future, like, I know we talked about the multipolar kind of world that is emerging, but with Project Enbridge and other things that is emerging, do you foresee just a constant effort by countries to really work on ways to circumvent the dollar in international trade?
100%, and I think if you want to supplant the dollar, I think what the Chinese are doing and the Middle Eastern countries are doing is stockpile gold. Yeah. Because if you want your country to assume more of a role of reserve currency, the way you gain trust is by backing with hard assets, particularly gold. Yeah. So I think the Chinese have very long-term horizons, 50, 100-year horizons, right? So there's a lot of fanfare. BRICS are going to announce a new currency tomorrow. I think they're just going to keep stockpiling gold, have more trade going through their local denominated currencies, and giving those trading partners comfort, saying, well, you can hang on to our currency longer than for 24 hours because our vaults are stacked with gold and we're backed with gold. I saw an interesting stat the other day that pre-World War or during World War II, 40% of the U.S. debt was backed by gold, the value of their gold holdings. Today, that's 2%. And it's not because they sold their gold. They haven't sold any gold, but the debt's just exploded. Yeah. So when you look about if you want to own someone's paper, own someone's debt, well, how much gold do you have actually backing your paper currency? Used to be 40, now it's 2. Yeah. I don't know what the numbers are in China because they don't disclose all of their gold holdings, or they have more than they say, or you can run that calculation, but I can bet you it's a lot more than 2%. Yeah. And so that's going to be a barometer of how much can I trust your currency in a world where paper currencies are devaluing. By the way, gold's not going up, right? The paper currencies are going down, right? And so in the world, that kind of world, the more gold you own will give you a lot more power, a lot more seat at the table, a lot more confidence to have that reserve currency. And on the flip side, the U.S. losing its reserve currency status has very negative implications for their borrowing costs and the ability to subsidize their lifestyle. Yeah. So I think there's a lot of, but these are multi-year trends, right? I'm not saying come tomorrow in the U.S. reserve currencies. That's going to be a slow erosion of reserve currency status, constantly higher interest rates versus what they've had in the past, and a gaining of prominence of other countries that are diversifying into hard assets.
Yeah, no, well, it's excellent, Michael. I guess that's it. I could talk to you for another hour, but I think that's everything that we can get through today. But I'm looking forward to having you on my show in the near term. So, no, thank you very much for the conversation.
A lot of fun.
Yeah,
thank you.
Thank you.